The Federal Reserve Bank just confirmed that Americans are poorer today than they were back in 2019. The Federal Reserve Bank of San Francisco released this data yesterday. What they said is that the top 20% of earners in America have 2% less liquid assets today than they did back in 2019. What is a liquid asset? That includes things like checking accounts, savings accounts, money market accounts, and your stock market accounts. But if you look at the other 80% of America, they have 13% less assets today, less liquid assets today than they did 5 years ago. Again, that includes checking accounts, savings accounts, money market accounts, and stock market accounts. And the reason why I wanted to report this in this video today is because last week, on the other coast, the New York Federal Reserve Bank published their own study on delinquencies in America. And what they found is that number one, credit card debt broke a new record high in America, which not that surprising, but even more importantly, what they said is that over the last 12 months, 9.1% of credit card balances transitioned into delinquency. And when the Federal Reserve Bank published this, TransUnion, which is one of the three major credit bureaus in America, responded to it with some very profound words. What they said is, quote, borrowers with revolving debt are maxing out their credit cards, and that's usually a pretty good indicator that people are stretched. Some profound there, some TransUnion. And the reason why this matters, again, is because we are in a spending-based economy. The more money you spend, the more money somebody else makes, the more money that our economy grows. And our spending-based economy relies 2/3 on consumers, meaning regular people make up 2/3 of our economic system. Who makes up the other 1/3? Well, that's none other than the United States government, because the government spends a lot of money in our economic system, building bridges, building roads, spending money on military, spending money on teachers, and everything in between. Well, the reason why I'm bringing this up right now is because we got a third piece of very interesting data yesterday, when Reuters published that between July 2023 and July 2024, the federal deficit jumped 10%. But still, that's not the interesting part, because the federal deficit month over month can be manipulated depending on when the government actually spends money, whether it's the beginning of a month or the beginning of the next month. The more important part here is that debt servicing costs year over year jumped up 21%, meaning the United States government is spending 21% more money monthly than last year, paying back their debts plus interest, because debts are readjusting at the higher interest rates while the government keeps racking up more and more national debt. So what I want to do today is go over a few things. Number one, I want to go over why Americans feel poorer today than they did back in 2019. Number two, what's going on with delinquencies? And number three, what can you do to build wealth while you see all these crazy things happening? And a quick reminder that on August 14th and 15th this week, I'm hosting my biggest investor workshop of the year, where I'm going to be going over, number one, how our money has changed over the last 5 decades and over the last 5 years. But even more importantly, number two, how can you build wealth in this changing economy? How can you find financial trends in this economy where we still have high interest rates, where we still are seeing the higher inflation, where we're seeing slower economic growth? How can you build wealth and find investment opportunities? This is a free workshop. It is live. I'm hosting 2 sessions, one on the 14th and one on the 15th. If you'd like to join, all you have to do is register. I got the link for you down in the description below. Just remember, there's a limited number of people that can join me live, so please register soon if you are interested in joining. So, starting with why more Americans are feeling poorer. Richer Americans, the top 20% of earners in America, have 2% less liquid assets, while the other 80% of Americans have 13% fewer liquid assets. What that means is that if you had $100 in your bank account back in 2019, today you have $98 if you're in the top 20%, or you have $87 if you were in the bottom 80%. The reason why this is important for you to understand is because this is only half of the whole picture. The other half of the picture is that the prices of things have risen significantly over the last 5 years. The reported inflation numbers will tell you that the prices of things have risen generally between 20 to 25% over the last 5 years. Although the real inflation that many people have felt tells you that the prices of things have gone up by 50% or more over the last 5 years. So the prices of things have risen by a lot, while people have less dollars in their bank account. This effectively makes most people poorer today than before, because you're trying to spend with less dollars buying more expensive things. Now, there's a lot of reasons why this happened. There was a big boom in wealth amongst everybody. Rich people, middle class people, and even lower income Americans saw, in general, not everybody, but in general, wealth grow during 2020, 2021 as money was given out in form of stimulus checks, unemployment checks, asset prices were going up before we saw the big inflation boom starting in 2021. Well, the reason why this is significant for you is because now we're starting to see delinquencies rise as well. The New York Federal Reserve Bank said that, quote, credit card and auto loan transitions into delinquencies are still rising above pre-pandemic levels. Now, let's go back to how our economic system works, because our economic system runs on spending. The more money you spend, the more money somebody else makes. When you go to Chipotle and you buy the extra guac, it is good for Chipotle because that extra guac is going to pay somebody's salary. When you go to Gucci and you buy everything on the shelf, it's good for Gucci because now they have the money to open up another store. But if you go to Chipotle and you start downsizing, and now instead of buying a bowl with the extra guac, you say, you know what, not only am I not going to buy the extra guac, give me the Skinnylicious burrito. Well, now Chipotle is making less money, and they have less money to pay their employees. Maybe they have to downsize, maybe they have to hire less employees, maybe they have to lay off employees, maybe they have to shut down stores. And if they're shutting down stores, that means the landlord is also making less money. If the landlord is making less money, maybe that means they can't pay their bank. If they can't pay their bank, maybe the bank goes into default. If the bank goes into default, they also have to lay off employees. See, this is how our economic system works. I get it. I took this into a big extreme, but the domino, I just want you to understand how $1 flowing through the economy affects many different entities. So when we have this sort of spending-based economy that revolves around debt or credit, it is great when the economy is growing because that means you can buy more stuff. Sure, it's on credit, but who cares? Everybody's making money. That means you get to have more stuff. That means businesses get to make more money. That means more people get to have jobs, and everything is good as everything is growing. But then eventually hit this breaking point where people then max out their credit cards. They can't continue keep spending. They can't continue buying more stuff. And then you are forced to become financially smart because the credit card company will not issue you any more debt. When that happens, well, now you have to, instead of buying more stuff, you have to pay down your credit card debt. And that might be good for you to pay down your credit card debt, but that's not good for the economic system. Because that means now instead of you going to Chipotle and buying the Skinnylicious burrito, you can't even buy the burrito. You got to make your own Chipotle at home because you can't afford to eat out anymore. So you can start to see how spending can impact many different parts of the economy, and then it becomes amplified when you have a credit-based spending economy like we have here in the United States. Well, what's interesting now is that the Federal Reserve Bank has said that they want to cut interest rates this September. And although Wall Street is pushing the Federal Reserve Bank to hopefully cut interest rates sooner, we don't know what the Federal Reserve Bank will actually do. But the reason why I'm bringing this up is that in anticipation of the Federal Reserve Bank cutting interest rates, we've already seen mortgage rates fall. Why does that matter? Because along with mortgage rates, refinancing rates have also fallen. And because refinancing rates have also fallen during a time where home prices just broke a new record high, we just saw a boom in refinancing applications. Week over week, we saw refinancing applications, mortgage refinancing applications, jump by 16%. Why does that matter? Well, let's go back to everything we've been talking about. Home prices have hit a new record high, and when home prices go up and you own a home, that means you have more equity in your home. Well, there's two ways you can tap that equity. You can sell your home, or you can do a cash out refinance. Well, if you do a cash out refinance, like we're seeing more and more people do now, that means you still own the home and you get to borrow money from the bank tax-free. Which, sure, you could use that money to invest in the S&P 500. You could use that money to buy rental properties. You could use that money to start a business. You could use that money to invest in other businesses. But what we've seen is that the average American, when they do this cash out refinance, they use it as a separate savings account or a separate checkings account so you can pull cash out and buy a vacation, buy a boat, buy some new clothes, maybe buy a car. And so now as we see refinancing rates drop or refinancing rates jump because mortgage rates have been falling, it poses an interesting dynamic because one thing that I'm going to keep my eye on is how that will affect spending and if that impacts inflation at all. Because if we start to see a growth in demand to purchase things, which we'll see what happens, that could start pushing the prices of things up more, although there's a lot of kind of up and down pressures on inflation right now. But the more important thing is if we do see interest rates start to drop, how will that affect the economy? How will that affect spending? And how will that affect what the Federal Reserve Bank does? Because remember, the Federal Reserve Bank makes their interest rate decisions based off of inflation and based off of the economy, particularly the job market. And if inflation comes down, which is what we've been seeing happen, while the economy still is growing, because if more people start spending money and we start to see more economic growth again, well, maybe the Federal Reserve Bank won't need to be as aggressive to cut interest rates. Because remember, higher interest rates are good for people that have cash. Higher interest rates mean you can get a real rate of return on your cash through treasuries or even through a high yield savings account. A lower interest rate means, well, if you're sitting on cash, your cash is losing value. You're going to want to dump the cash into assets. Lower interest rates generally mean asset prices rise. Lower interest rates generally mean that inflation goes higher. So it's an interesting dynamic here because the Federal Reserve Bank doesn't want to trigger another inflation spike by cutting interest rates too soon. So it's something for you to keep an eye on. We'll be keeping you posted on market briefs. But when it comes to you building wealth, what this means now is what we've been saying for a long time, which is number one, you got to be financially prepared. That means you have to have cash put aside to protect you against an emergency and also have cash put aside to be able to capitalize on investment opportunities. That's part one. Part two is be financially educated. That means know your strategy. Your strategy might be dollar cost averaging, which is I'm investing into the funds, maybe S&P 500, maybe the total stock market, maybe some other fund. Again, I'm just a random guy on YouTube. I can't tell you what to do. I'm not a financial advisor. You got to do your own due diligence because investing has risks. You never want to blindly trust a random guy on YouTube. But if you're dollar cost averaging, what that means is you're just investing your money into the markets, whether the markets are up or down or sideways, whether it's raining, whether it's sunny outside, it doesn't matter. You just keep investing your money no matter what. Or you might have a more active investing strategy, which is where now you're looking to invest your money into a particular company, into a particular type of thing, asset, and now you're just waiting for a good buying point. And in order to do that, you're taking money and you're putting it aside. That way you have this growing pile of cash waiting to be invested. That's what financial education is all about. That way you know what your investing strategy is and you know how to analyze your investments. The third piece to this puzzle is understanding the financial trends. Knowing where the money is moving, because you as an investor want to invest your money where the money is going, not where the money was. And in order for you to find these financial trends, you got to pay attention to what's happening. Look at consumer behavior. Look at changes of regulations. We'll be talking about this in my investor summit this week. So if you haven't joined, be sure to join if this is something you want to learn more about. But you want to pay attention to financial trends because you want to find an opportunity that's going to be growing in the future, not that's shrinking in the future. And then you want to be able to execute. Don't get caught up in the emotions. We saw what happened the last week and a half. Don't get caught up in the emotions. Look for opportunities and use them as opportunities to build wealth, not as opportunities to just chat about what's happening on the internet. Actually pay attention to what's happening that we can execute and build wealth when you see those opportunities. And with that, I'll see you tomorrow.